Hello, my name is Jack Camille. I'm a financial advisor here at Harrison Brook, and today I'm going to talk about fixed income investing for expats. Fixed income refers to investment instruments that will offer a fixed rate return over a set period of time. So these may be things like bonds, gilts, which are UK government bonds, treasuries, which are US government bonds. Within our investments, we're really going to focus on things like bonds, which would hold an array of these types of instruments. And on a very basic level, a bond is someone wants to borrow money off you. So the UK government or corporation, they borrow money off you. They will then pay you that fixed rate return over a set period of time, 5, 10, 20 years. And at the end of that period of time, they will give you your capital of investment back. So for some background context, we're in April 2023. Last year was the worst year on record for bonds. Two key reasons there. If we think that bonds are there to pay interest, usually not the highest amount historically, then record high inflation and rising interest rates are both a nightmare scenario for bonds. The high inflation means your purchasing power is being lost, and the higher interest rates we'll come on to now. So the effects of those higher interest rates, which are being set by central banks, Bank of England, Federal Reserve, European Central Bank, essentially filters down into the retail banking system. So what that means is after 10, 11 years of you not being able to get any sort of return from your savings, you're slowly able to get them. If the federal funds rate is set at 4.5, in your bank you may be able to get 3.5. For bonds, it has a couple of effects. That obviously devalues old bonds, because the old bonds that's paying you less interest with a lower income payment is now far less attractive if you can go and get the same level of interest with zero risk at all from your bank. Furthermore, when you increase those interest rates, new bonds that are being issued, so bonds are always being issued to raise for new projects, they're going to come in with a higher interest rate. So that is where the value is really held in using an active bond manager who is having long and short duration bonds from different types of issuers in order to mitigate these risks. When comparing this to general income investing, there's quite a big difference. Fixed income, so bonds, are low risk. They're debt-based instruments. Someone's borrowing money off you, paying you a level of interest back per quarter, per annum. Depending on the person borrowing it, or the company or government, that decides on how risky it is and the yield you'll get, which is the income payment against the value of the purchase. General income investing refers to things like real estate investment trusts. So this is the return you can make from property, particularly commercial property, and also dividend paying companies. So we will think of this as blue chip companies that have been around for a very long time. They're no longer going for growth, but they will deliver profits every year and they will then be shared back to you. There's a number of these companies in the UK, so the FTSE 100's got a very good dividend paying stock. This would cover things such as insurance companies, finance companies, oil companies. Here your return is likely to be higher and reasonably consistent, but the value of that stock can of course also drop. So if you're getting somewhere about 7 or 8% from a dividend paying stock, there's always the risk of course that the value of that stock drops significantly, which as long as you're holding that stock with an array of others isn't too big a concern. But if you are over dependent on that, it's going to increase the risk level of your portfolio, and that's something to consider. Any expat looking to generate income, there are a number of considerations. Risk level obviously plays a key part in the types of assets we would utilize in order to generate that income, as does the amount of money you have to invest and for how long a period you need that income for. Fixed income will always make up part of that. It is low risk. Now with higher interest rates, you can finally get a better return on it. but we wouldn't want to be over reliant on one key source, so a UK government bond, for example, or one key geographical location, or one key type of business. On top of that, you have your dividend paying funds, and you have your real estate investment trusts. The likelihood is we'll use an array of those, as well as some other areas such as capital growth funds, so we're not over dependent on those specific niches. Please do feel free to get in touch if you'd like to discuss your income requirements further.